Hello, and welcome to Macro Minutes. During each episode, we'll be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome back to Macro Minutes. Today is the 21st of January 2026. My name is Peter Schaffrik, and I will be your host today. When planning this episode, we were certainly not short of topics. Between renewed threats to the Fed's independence, renewed tariff threats, and counter threats, a hard JGB sell-off, we probably have more to unpick than we can actually cover in one episode. But we shall try as hard as we can. We labeled this episode Beware the Cracks, which might apply to geopolitics just as much to markets as it appears. I'm joined today by Blake Gwinn, RBC's head of US rate strategy and resident Fed watcher, as well as Richard Cochinos from our FX strategy team. I suggest we jump right into the deep end, and I would like to start with Richard. Richard, so let's start with the topic du jour. We seem to have a little bit of a mini replay from the Liberation Day playbook following the recent geopolitical events, and the US dollar is weakening. So what matters more for the US dollar, Greenland, Venezuela, or US earnings and something else entirely?
That's a great question, Peter. And the answer, unfortunately, is both. In the sense that if you look at price action and the dollar and currency markets this week, it's not necessarily Greenland and Venezuela, or I would say the geopolitical risks that matter, but really what was driving the dollar sell-off and the 1% lower in the USD that we have this week was the threat that the US was looking at an additional 10% of tariffs on European countries that were opposing the U.S. desire to acquire Greenland. That's something which immediately affects trade, immediately affects global growth, it changes global risk, and at the end of the day, with stocks down in the U.S., the dollar is down as well. This is where it's the push and the pull. If we look at the U.S. purely and the dollar purely from the U.S. domestic perspective, the outlook is very favorable, right? We have very strong growth, some of the strongest in the G10 currently right now. It's expected to be well above 3 to 4% on an annualized basis for Q1. And if we actually look at kind of the overall outlook, we have a central bank which, the market is expecting only mild cuts, but you still have mild cuts expected in a non-recessionary environment. You have very strong growth, all of that very favorable for U.S. asset markets on itself. Again, from the foreign perspective, the U.S. is becoming now a riskier country. And this idea of threat of tariffs really does change the outlook for both U.S. stocks and the U.S. dollar. And that's what's causing some of the short-term dollar weakness coming through the market. Prior to Saturday, the market seemed almost comfortable building a long dollar or a short euro position, again, on this more fundamental outperformance U.S. growth story. So when I say it's both of them that matter, it really matters on the horizon. Right? If the U.S. does push forward these additional tariffs and there's a European response to it, it's likely we're going to get greater dollar weakness going forward. Absent that being a direction of macro and market risk, it's likely that we're going to return back to this idea of investment in the U.S., which tends to lead to additional dollar strength.
Let me move it to Blake and stay on a slightly different but related topic. So the dollar was not the only thing that went down. Treasuries and specifically the long bond also took quite a bit of a beating. So these are big moves in US yields and spreads and the re-steepening of the curve over the last few days. What do you think is actually driving it, Blake?
Yeah, I think there was a mismatch of things that also in turn turned into a bit of a positioning squeeze, probably mostly on the kind of fast money hedge fund space. Over the last month to 2 months, we've really seen investors loading up on these long carry positions. I think that's largely a function of the fact there's been very low directional conviction on rates. We've seen vol collapsing. So investors have really been moving into those carry types of positions. And with that backdrop, you kind of head into last Friday. We got some headlines around the Hassett versus Warsh FOMC race, basically suggesting that Hassett may not be the choice for Fed chair. That kind of seemed to provide some of the initial trigger, but I think that quickly started to spill over into a bit more of that positioning squeeze that I was talking about, putting some of the pressure on those carry positions. I think you also had a little bit of focus on Treasury's upcoming refunding release last Friday. Treasury released the survey that they do every quarter of primary dealers. There's always a bit of a focus on that, looking for some kind of signs that Treasury is going to change their issuance. If they were going to change it, that would generally be in a direction of pushing rates higher, increasing long end issuance, et cetera. We really didn't get anything there, but that focus may have also been in the ether when we're thinking about things that were driving that sell-off. And then I think after Friday into the weekend and then Monday with the US closed, then we saw the price action in Japan related to idiosyncratic factors there, but that started to spill over into US. And the overnight session when we saw treasuries open, they were following on that sell-off in Japan. I think you couple all this with the fact that the risk environment was pretty downbeat. Equity futures were also down quite a bit from Friday's close as we headed into this week. That also added some pressure. That was largely around these Greenland headlines, potential new tariffs, et cetera. And then lastly, I would just say the volatility itself. So once we saw yield starting to sell off on Friday, once we punctured those ranges that have been very well established for quite some time, that in and of itself probably shook a few people out of this complacency that we've had on these very tight ranges with low vol and everybody focused on carry. I did think it was a bit interesting. Once we got into the Tuesday session here in the US, things did start to stabilize in the US trading hours. We basically closed with 10s, or basically unchanged from where they came into the US session at 9 a.m. It's interesting when you compare that to equities, which continued to grind lower throughout that US session. We got a lot of news flow on Tuesday. There were all these headlines coming in on the foreign relations front, on trade front, on the Fed chair race, but I didn't really see anything there that would have fundamentally reversed that kind of move or stabilized rates. I really think it was just that we had this kind of dip buying mentality. As I mentioned before, this was really a fast money hedge fund focused trade. You probably had some real money people with dry powder, very quick to come in and buy that dip. That was also true in spreads, basically the same story. We had a lot of whipsaw overnight and then essentially stabilizing during US trading. I think people were just very quick to come in and buy that dip.
Let me maybe follow up, and I'm not quite sure to whom to put the question, maybe to the both of you. There seems to have been a little bit of a resurgence, albeit still quite minor, of the de-dollarization theme that we had earlier in the year. So specifically, one of the headlines that I've seen was this announcement by a Danish pension fund that they would be moving away from US treasuries and the dollar. Is that credible? And what do you see? What are the flows suggesting? And maybe I just throw it to Richard first before I give Blake a bite at it.
Yeah, de-dollarization. I'm going to shift that buzzword to diversification, if I can, when talking about currencies, because there's a couple of things. And if I'm going to zoom out and talk about the dollar from a long-dated perspective, you got to talk about asset allocation and strategic asset allocation in U.S. assets relative to rest of world.
Right.
Now, the world has built up an overweight on U.S. assets very passively, but very intently over the last 15 years because U.S. equity markets and U.S. fixed income markets have been major outperformers. So again, when you think about your strategic portfolio, as long as those markets continue to outperform, you're going to continue to hold your overweights. And those have drifted larger over the last 5 years, over the last 10 years, over the last 15 years, really since the global financial crisis ended in 2009. Okay, so that sets the framework for an existing overweight on U.S. assets relative to what your strategic benchmark should say. De-dollarization, there's a passive reallocation or an active reallocation, and then specifically on currency, a hedging flow. I take a look a lot at the tick data, and I won't talk too much about it because I know Blake will as well. And if you look at foreign purchases of U.S. assets, meaning U.S. stocks and the major U.S. rate markets, those have really only gone up since COVID, and interestingly enough, since 2025, when we first talked about this theme, they've been net buyers of U.S. assets over that full horizon. So in other words, they are continuing to buy U.S. assets. But with the dollar in particular, it's the stock of assets you own that's much larger, right? I think foreigners own close to 22 trillion in U.S. equities. versus 7.8 trillion in U.S. Treasuries and 1.4 in agencies and maybe 5 trillion in corporate bonds. But the point is, foreigners own about 36 trillion in U.S. assets. Now, they've continued to buy, but what's more important is what's their hedge ratio on those assets. That really is the big flows that drive a dollar stronger or weaker. We think those hedge flows were low starting 2025, and they were obviously the 8% of dollar weakness that we saw over 2025. They've come up a little bit, but the Fed has been slow to cut. It still has rates elevated to rest of world. We think that the market is expecting it to cut a little bit more this year. As that cost of hedging comes down, that unleashes additional waves of dollars selling. With the last 48 hours, always a knee-jerk reaction to headline. I don't think this is really structural changes in hedging flow behavior that would cause more medium-term dollar weakness, but that's also something that we very much expect over 2026 and 2027. How fast it is really comes down to the rates discussion and the Fed discussion, meaning how cheap does hedging become for foreigners on their U.S. assets, or what's the immediate need, right? Big spikes in volatility, they're going to need to hedge quicker, which can cause additional waves of dollar weakness. Those are the two things that we have in mind when we're looking at Q1 of 26 and the whole of 2026.
Yeah, I was just about to say, I get it. It's more of a, for the dollar, it's more of a hedge story rather than the underlying assets. So maybe a good point to bring Blake in. What do you think on the underlying assets, specifically in treasuries?
Yeah, Peter, on the underlying assets, look, we went through a bout of this back in April and May of 2025, and I don't want to belabor a lot of these points. We spent a lot of time back then, both on this podcast, but also in our writings, discussing all the reasons why it is very hard to structurally pull away from owning treasuries. I'm not going to belabor all those points. It is a massively deep and liquid market. The types of size that we'd be talking about, it's very hard to find places to actually move with that cash if you're looking for other safe assets that have the depth and liquidity that would be needed. The fact that such a large number of international transactions are still denominated in dollars, it's just a very, very difficult system with a lot of very positive network effects. It makes it very hard to pull away from treasuries writ large. Now, all that being said, and this is what we highlighted back in April and May of last year, you can say all that and you can look at these headlines and say X, Y, or Z investor really doesn't hold that many treasuries. Let's say we find out some pension fund is liquidating 10 billion of treasury holdings, 50 billion of treasury holdings, et cetera. Those numbers may not amount to much, especially when you consider how many treasuries are actually changing hands every day. That may be a drop in a bucket. That's not really what concerns me, but what I'm a bit more wary of is that you get enough headlines like that and it really starts to become more of a fear of this de-dollarization story again, like we saw in April and May. And that's what could actually end up pushing yields higher, is that it's not the single pension fund that shows up in the headlines liquidating that pushes prices higher, but it's the dozens of other large portfolio managers that see those headlines, get a little bit worried, start being a little bit more cautious on rolling their treasury portfolios, in participating in auctions, and adding to long positions, et cetera. It's really those knock-on, it's really the vibes, it's really what that could do to sentiment. I will just say it's always been true that I think this kind of fiscal sustainability, quote unquote, who's going to buy it all, those fears run very deep in some investors' bones. And I think stories like what we saw with this pension fund, those are really positive confirmation for those very deeply ingrained fears. So that's something I'm watchful of. It's not the flows I'm worried about, but I am worried that we get into another kind of mini bout of panic about de-dollarization, and that alone could be enough to put some upward pressure on yields. That's certainly what I'm looking for. What could be the tipping point? I think if we start seeing more of those stories in the coming weeks, that could certainly set that off. But ultimately, like we saw in April and May, and I would even throw in 2023, this August to October period where people were really worried about deficits, and we saw this kind of mini freak out around deficits. Both of those periods, what ultimately ended up happening is that markets moved back to really focusing on the Fed, the macro outlook, et cetera. So it really did prove temporary. That's what I would expect around this, but that doesn't mean these kind of fears couldn't send rates, or risk that those fears could send rates higher in the near term. Peter, if I can turn this around a bit here, given that you're on the European side and you're here with us. So what do you think on this topic from the European side? Do you see any evidence of these types of rotations, or is that something you're concerned about or think is going to drive yields in the near term?
I'm totally with you. I think generally there's not a great alternative to these very large amount of treasury holdings. What I would say is two things. First of all, we know that Europe as a whole is a very large holder of treasuries. And going back to the point that Richard has mentioned earlier, even a little bit of diversification away out of Europe could potentially amount to quite a meaningful sum. That's number one. And secondly, whilst I generally say that we in Europe over here are not we don't have a directive economy, there are some funds that probably take a little bit more cues from, let's say, the government or generally some major stakeholders. So I think that there could be some who are a little bit more prone to that. But having said that, I think maybe a broader point that I can make is, since this week, I do feel that the sense in Europe has really shifted up a notch on the worries about what the US wants to do, how much they get away with, what the Europeans need to do. And the sense that I can see is that in contrast to Liberation Day, where it was basically the whole world, this is like US versus Europe. So I could see maybe some stronger reaction coming out of Europe than otherwise the case. But generally, I agree. I don't think this is the point where Europe starts to dump all of their treasuries and buy something else with it. That's not going to happen. By the way, thank you for bringing me into the conversation as well. If I can move the conversation on a little bit and maybe staying with you, Blake, you mentioned earlier something that I would like to return to. You mentioned the Fed chair discussion, which is obviously another big theme for the market here. Can you just dive into that a little bit more? What specifically are you and the market focusing on here?
The Apprentice FOMC chair edition, this just keeps dragging on and on. We've seen this kind of horse race where it seems like Hassett, it seems like Warsh, and we've been moving back and forth. I think what got things going, when I mentioned before that it was a bit of a driver last week, it was really the surge in Warsh's and pullback in Hassett's odds that really started to move things. And I think the reason for that is that markets have generally decided that Warsh is more negative for Treasury, more negative for spreads. I think that's in part because he's seen as, whether this is true or not, he's seen as potentially more independent than Hassett's, maybe not as dovish on the rate front. But I also think more importantly, probably, is that there is this contingent out there that pretty firmly believes that some of his prior hawkishness on balance sheet policy is something that could drive things, so that he may come in and try to significantly reduce the size of the Fed's balance sheet. That could mean continuing QT, so getting that started again. Remember, the Fed just stopped QT late last year, or perhaps even selling assets out of the Fed's portfolio. Now, to be fair, I think those are very unlikely. I think the contingency that really views things this way is probably pretty small, but presumably they're still trading. So I think can still drive some price action there. I would also just say, even if I disagree with this, and this actually tracks back to what we were just saying about kind of the perception around de-dollarization rather than de-dollarization itself, we've seen this in the past with these Fed chair races, that once the market decides on a narrative of what each of these individuals represent, it's very hard to fight against that. Now, personally, we've been of the mindset that whether it's Hassett or Warsh, the actual outcomes that you're going to see over the next year, 2 years, very, very similar. They're not going to be doing anything particularly different on rates policy. They're not going to be doing anything particularly different on balance sheet policy. And even if their views are slightly different on those things, their ability to affect diverging policy paths is relatively limited. We've been making that argument a lot on the rate policy front, that basically one participant, even if it is the chair, is not really enough to change course to deliver these kind of uber dovish outcomes that some of these candidates for Fed chair have been discussing. And I would say on the balance sheet side, after the Fed restarted those purchases in December, we're calling RMPs now, the rest of the committees basically established that they don't really have tolerance for repo market volatility. So I don't think Warsh can just come in and change that. But again, to my prior point, it's really hard to break that market perception, and the market still seems to be trading Warsh in this kind of negative for spreads, negative for treasuries type of way. On the balance sheet, regardless of what he can actually get through the rest of the committee, we have to think about Powell. We have to think about Trump as well. And I think if you have Trump as mad as he is at Powell, wait until you see what happens when his brand new Fed chair basically decides to start selling Fed assets and pushes mortgage rates 100 bips higher. We know from their actions over the last couple of weeks, some of the policy changes they've been talking about, the restarting of purchases of MBS, they care a lot right now about mortgage rates, about borrowing rates, selling assets out of the Fed's balance sheet or shrinking the Fed's balance sheet in a way that would push those rates up. I just can't see any tolerance for that. It's just really hard to see Warsh enacting some of these balance sheet policies that I think some people might be expecting when they're selling treasuries on this theme, steepening the curve, et cetera.
I can certainly see the tweets afterwards would have a lot of capitals in it. I can definitely see that.
I can't imagine he'd be happy.
Let me shift the focus a bit, and it's probably more for Richard, really. It's related to the treasury sell-off, but I would quite like to move to Japan. So the yen is at its weakest it's been in decades. The JGB market is stuck in a multi-sigma sell-off, and equities are up actually 7% in the past month or so. What do you reckon is going on, and maybe which of those is going to break first?
You alluded to that yen is weak. If you chart it up on either your computer or Bloomberg or anything like that, you can see that dollar yen hasn't really traded above 160 in a material way and stayed above there since 1986. And so we're just a hop, skip, and a beat away from 160 currently right now. It's tested it a few times, and recently the BOJ was intervening, meaning 2024, was intervening in FX markets to really keep it from materially moving higher. Now, in the short term, what breaks? It's either going to be currency or the equity market. JGBs are very much undergoing price discovery right now. That's a process which is likely to continue over the next couple years. Currently, the Bank of Japan is still actively engaged in quantitative easing, meaning they're purchasing JGBs in the primary market and the secondary market on a monthly and quarterly basis. Now, they're tapering those purchases, but they are going to still be purchasing them in 2026 and 2027. So as that taper comes down, meaning they're purchasing less on a monthly and quarterly basis, naturally you need substitution of the private market to buy those bonds, and it's very clear the private market is requiring higher yields. So that process of JGB yields higher is going to likely continue over 2026 and 2027, which brings us back to the currency. And the higher those bonds go, the more, I would say, the incentive for Japanese domestics, which is a lot of fixed income investors, is to invest domestically. And that kind of creates a giant sucking sound out of global fixed income and currency markets. Right now, Japanese investors purchase about $100 billion worth of foreign bonds. Most of that is in treasuries on an annual 12-month rolling basis. That number fluctuates between 300 billion and 100 billion, but importantly, it's been falling all of 2025. And that's something that, again, yields higher in Japan. That Japanese demand for foreign fixed income and for U.S. yields, that risk reward changes, where, again, they can get better yields staying at home than they can from investing in treasuries and then FX hedging it back to the Japanese yen. So that's a flow that we're expecting this year, which will lead to less yen selling, hence dollar yen lower in the FX market. Now, because obviously the other main trade in Japan is what's known as the Takaishi trade, or Japanese fiscal stimulus, supersizing Japanese equities outperformance. As the currency appreciates, that's likely going to help. It will basically put a cap in terms of the acceleration higher in Japanese equities that we've seen. That is a very large foreign participation in the recent run-up that we've seen since Q3 and Q4 of last year. So again, as the currency tends to appreciate, you're just going to see a little bit less participation. And Japanese equity markets are likely going to continue to trade higher, but just not with the blinding speed at which they've done it over the last 2 quarters. So that's kind of our playbook of how we look at Japan. The Bank of Japan, Ministry of Finance, probably going to be intervening in currency markets if dollar yen trades above 160. But at the end of the day, it's the shift in flow and the backup in JGB yields that's really going to cause, again, the Japanese demand for foreign assets to decrease. And that helps trigger medium-term yen appreciation.
You just mentioned intervention. That's another source of volatility. And if I may, as a last follow-up, I know we're running up to time, stay in Asia for a second. So in the volatile environments that we've seen over the last couple of days, the Asian currencies were acting quite a bit as a safe haven, which is a bit odd given their high beta. So first question is, can you explain that? And then related to that, can you give us maybe a bit of a highlight of your favorite themes in currencies and trades going into Q1? I know that CNY is high up on the list, currencies that you would like. What else are you telling clients at the moment here?
First question, can we explain the Asian outperformance over the last 48, 72 hours or since the dollar weakness is coming to markets? And you're right. Generally, when you see rates selling off, stock market selling off, things like Aussie dollar tend to sell off as well. It's very high beta to stocks overall, and it's appreciated. And we've also seen the New Zealand dollar appreciate, and we've seen the Chinese yuan appreciate all over the last 72 hours. I think it's important for clients to remember that underlying currency markets is always this change of order flow based on not am I just buying this asset because I expect it's going to outperform, but do I need to hedge my foreign assets that I already own as much? And one of the main things in Asia is that the cost of hedging has flipped between U.S. was the highest yielding asset market as we began 2025. And as we ended 2025 in November, Australia became the highest yielding asset market of all the G10 markets out there. In other words, for an Australian-based investor that was buying U.S. equities, generally they weren't really hedging those as much as they could because they got a little bit of a yield bump and a pickup by the carry being positive on the U.S. dollar versus the Australian dollar. Now that's flipped. It flipped in November, and it continues to accelerate away. So what we find is flows for Australian-based asset managers, they're actually starting to hedge more. In other words, for all of the stocks and the bonds that they own in Europe, and specifically the U.S. I'm going to talk about because that's the main investment market, that they are now selling the U.S. dollar and buying the Australian dollar because that differential, that carry pickup is now in their favor to be in Aussie dollars for those assets. And that's something which is likely to continue over this year and next year as well. So that shift of a carry dynamic really has created a more structural bid or buy signal on the Aussie dollar. It's one of the ones that we like as a year ahead theme. We're recommending long Aussie versus short the Swiss franc because that creates 4% in just carry differential alone. But we're also looking at what's the underlying theme of markets outside of Greenland and US and Europe. It's been a commodity story. You can see it in gold, you can see it in copper, you can see it in silver. Australia is a large exporter of precious and industrial metals, the same way Canada is. And that's created upward pressure on the Australian dollar as well over this kind of period where if you're unsure about US and Europe, well, asset markets tend to pivot to where they think there's going to be growth. We have additional fiscal stimulus in Japan. We expect additional fiscal stimulus in China to be announced by March. And you have a very strong commodity story and a growth story for the region. So all of that, when you're uncertain about the US and European outlook, tends to pivot capital flows to Asia. The Australian dollar, the New Zealand dollar, all have performed very well in this risk-off market, but also the Chinese yuan has continued to appreciate. And that's one that's, again, more of a structural view that we have. China has a very large trade surplus with Europe that we think it's trying to adjust by allowing the currency to appreciate going forward. And of course, the market is looking at its low growth and saying, for you to meet your 5% growth target, you're going to need to stimulate domestically, which also creates a lot of excitement about these Asian currencies as well. So that kind of is our strongest views. CNH outperforming the US dollar and the European euro is one of our year ahead trades that we're recommending currently right now. And long Aussie dollar versus short the Swiss franc CHF is another one which we're recommending for the year.
Guys, that's great insights. I'm certain that we'll return to these and related topics time and time again. It looks like we've not cracked anything irreversibly just yet, but sadly, I fear that the underlying topics will not simply disappear either. With it, the need to remain vigilant in the market and risk for quick and large moves will not go away. So thanks again, Richard. Thanks, Blake. Fantastic insights. Thank you for participating in today's episode. And thank you all for listening. Please join us again for our next episode of Macro Minutes.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.